the fact that it's $1 million house at 6% as opposed to a $200,000 house at 19% or something like that.
And it's where we're looking back from. When interest rates hit
2%. I wish we could
2.95%.
fix it for 30 years or something in New Zealand. You can do it overseas, but not an option
But
yet.
I was looking at it going, wow, I've never seen this in my lifetime before. Buying is now going, it's so expensive at 6%.
Welcome to Slice, Property Made Possible. We're a platform on a mission to reduce barriers to home ownership. This podcast is a safe space for our community to learn together and build the confidence required to start on their property journey. When you're ready to start, head along to slicetobuy.com and sign up for your free dashboard. Welcome back to another episode of Slice Your Property podcast. Today we're joined by Nigel, founder of YouOwn. Thanks for joining us, Nigel.
Thanks, Amy. It's great to be here.
It's great to finally get you on an episode because I know we've caught up over the last few years and I've heard about what you're doing, and obviously we try and send clients through that fit your criteria at YouOwn. So yeah, a good opportunity to educate more about different options available.
Thank you. We've both been around quite a long time in this space. So,
yes, we're still here.
There's a few survivors.
Totally. So we kick things off by asking you about your first home journey. What did that look like for you, Nigel?
Well, it's probably not dissimilar to the journey that a lot of people face nowadays. It was back in 1986, so quite a long time ago, giving my age away here. But the same challenge is that we didn't have enough deposit, and at that time the banks required 20% deposit. So we sort of did what I think most people did then, was we drew down our credit cards, borrowed from mum and dad, and scrapped the 20% together, bought an old dunga, which is sort of what we did in those days, because we then did it up, sold it, took
now
our capital.
It can actually be quite expensive to do up if you don't know what you're doing.
Yes, it is. And I think when you use all your deposit, you don't have the funds to actually do it up, so then you get stuck. So at YouOwn, we don't sort of encourage that at all. But I think we redecorating, new carpets, painting, doing the grounds, putting in fences, that all adds value.
Nice. So whereabouts did you buy?
In those days, it was Karori in Wellington. So I spent 16 years in Wellington before moving to Auckland in 2000.
Lovely. And what do you remember? So the deposit was challenging. What were interest rates like back then as well?
They were very high.
Yeah.
At that period when Roger Douglas came in, the economy was deregulated, and so we were all sort of used to that stage of interest rates with double digits.
Yeah.
But the difference, I think, was the multiple of a house to income. And that's what's changed since I bought a house. So while we had to find creative ways to get the 20% deposit, we could afford the mortgage at those interest rates because, of course, that's what happened.
Because the price, like the purchase price might have been 200 grand or something as opposed to 1 million. And then you might have been earning 20 grand or something. And still the difference between, earning 20 grand and buying a $200,000 asset versus earning 80 grand and buying $1 million asset.
Exactly right. Essentially what's happened since I bought a house is that affordability's doubled. I think at the time I was probably 4 times the multiple.
Yeah.
And that's just, of course, a function of where interest rates were.
Yeah.
So interest rates going right down, asset values go up. It's just an asset bubble.
Yeah.
And now fortunately, we're stuck with the problem. So I can't see that the current homeowners will want that to unwind.
Yeah, I just don't see that either. It doesn't really benefit those that are on the ladder, I guess, and that's a challenge.
Yeah.
And also we have a shortage of supply, so it's not like, there's a lot of houses going and therefore that's reducing,
That's correct.
the
There's
prices.
not pressure putting it down, that's right,
Yeah, it's a tricky situation we find ourselves in, but that's why it's great to have you and schemes such as the scheme that you offer. So can you tell us a little bit about your career history? Because I also know that you were at NZ Housing Foundation, which is another scheme that's available to Kiwis. Tell us about what that journey's looked like for you.
Absolutely. So in Wellington, it was in the finance sector, quite different, and I got into housing during that period when I was down there. Spent a couple of years before I left with what's now called Kāinga Ora, and looking at how to attract private sector investment into housing. And at that point, set up what was called the Home Lease Program, which has endured since then as a way of getting capital in. And with the change of government in 1999, that sort of that policy fell away. So I thought it was time to do something new. So headed up to Auckland, and at that point teamed up with Brian Donnelly, who just set up the Housing Foundation, and started again doing the same thing, looking at how do you actually try and increase home ownership rates. And that led to bringing in, doing a search and sort of looking at what other options are globally, which is what you do, and found that shared ownership is a big component of housing in the UK and Ireland.
I was going to say UK's been an early adopter, I guess, of shared ownership.
It has been. Probably, gosh, when we looked at it, they've been doing that for 40 years. It would account for most of first home buyers, and the percentages that those housing associations own would be much bigger than what happens in New Zealand at the moment. And that's because the government funds those housing associations so they could buy much larger stakes. That doesn't, of course, help the property market go down. It props it up, but that's the reality of it. It helps people into it.
Yeah.
And so what we did was we brought that model into New Zealand in 2008. And that began a long journey, really, because we had to write an agreement, had to go around and educate all the banks and get the program underway. Just with new housing, we even had to go and see the Reserve Bank and explain to them what we were doing, so the banks would be on side. And that worked over time. Over the time I'd left the Housing Foundation, we had all the major banks on board, as well as SBS and Kiwi Bank. So it was really successful.
Really successful. And I think what's interesting about that is, or interesting for me, is the agreement element. It's like every scheme, or buying with family, or buying with a partner, it's a similar agreement structure that helps you in, which is that co-ownership agreement or that shared ownership agreement. So we can talk a little bit more about that, but basically NZ Housing Foundation, YouOwn, Slice if you're buying with family or friends, any of those schemes all require the same agreement. So there is some consistency, at least in terms of what that structure looks like. But so with NZ Housing Foundation, do you want to share, we'll try and get Dominic on maybe an episode one time, but do you want to share a little bit about what that looks like for the audience as well, and then we can kind of compare it to what you're doing now with YouOwn?
Sure. So the Housing Foundation is a charity, and it was set up to target an audience generally at the time, and it's probably not too similar now, is around household income below $100,000. Mm. And the reason for that is that it is a charity, and to maintain its charitable status, it needs to be helping that sector of the market. And it had two programs, basically a rent-to-buy program, because at the time there were a lot of what I call sort of ropey rent-to-buy programs in the market. So we wanted to set one up which was, again, could become a benchmark and a reference. So we did that, and then shared ownership. And with the Housing Foundation, it will put in basically it'll go to the bank will work out what the family can borrow. Housing Foundation will put in the difference up to 40%. So the family always has 60%, and those funds have no cost on them, no charge, which is the huge benefit.
Charitable element of it,
Exactly, and of course, if you're trying to help that segment out, if you're going to charge them for the money, then they're really going around in a circle. So the idea is using KiwiSaver, that's the family's contribution. The Housing Foundation put in the difference, and they worked on a 15-year time cycle to be able to move through. And these programs, whether it's YouOwn, your program's the same, is that the idea is the loan from the bank's principal and interest, so over time you're paying that loan down and you're building equity. Mm. And house prices in New Zealand go up, and it's cyclical.
And it generally over that 10-year period, which is why they're saying, we want you to... They're encouraging more the buy and hold strategy, I suppose.
Yes, they are. And that's, again, that's just one of the things with that sort of strategy. It is buy and hold. It's pay down debt, wait for the market movement that's in your favour, and then you can look at buying out part of their
portion of
and with a 40% portion, it tends to be what they call staircasing in chunks. Yeah. And then you draw down funds from the bank that you've paid off, buy another share. And so it's
basically you've accrued equity, and then you leave 20% in the house and you refinance to make those payments so that you own a greater percentage of the house. And I think what's interesting, because you mentioned it was about 100,000, it's only gone up to 110 now, so it's between 85,000 and 110,000. That's the criteria to be eligible for NZ Housing Foundation, which probably ties nicely into why you've moved into YouOwn.
Absolutely. Why did we set up YouOwn? For that very reason, that the market for a low deposit product is much broader than just
those that are sitting between 85 and 100.
Absolutely. And so we could see that at the Housing Foundation. There were a lot of applications that came in for people with greater income saying, hey, look, we don't have the deposit either, and the Housing Foundation has to turn those down. So I sort of saw all this coming through, and I thought it's like a light bulb moment. The market's out there. All we have to do is provide a product for them. And of course, you have these heroic thoughts, but it's a lot easier said than done.
Yeah.
So I moved on from the Housing Foundation and set up YouOwn. And a few years later, Brian joined me as well to help do that. And it like all startups, which it was, it's never easy, but we've got there. The challenges, of course, were finding the banking partners. While the agreement was the same, YouOwn had to find the money. And so the approach that we took was impact investing. So we approached some charities and community trusts and said, hey, look, why have your money in the bank? Why not take it out of your fixed interest deposits? We'll pay you the same return and you'll share in some capital growth. So it's like
You'll earn a little bit more, you're also doing something impactful.
Impactful,
Yeah.
So we beat that drum, and impact investing is not easy either. So,
it's hard to get money from anywhere.
And unfortunately, a lot of money, we thought targeting charities, community trusts, like it's a logical thing to do, but all those organisations generally tend to be under some form of or mandate. They'll have external advisors.
Criteria, their own criteria, yeah.
And they'll go, hey, we don't have an allocation for, we could call it private equity or impact investing. And so I think there's a journey that New Zealand has to go as well to get the funds for this. So that's one of the learnings that I sort of thought it would be a logical product, would have lots of support. But
yeah, it's a challenge we have too, though, like obviously we're all attacking this massive social problem around housing, yet it's pretty hard to get funding, and they'll throw money at, AI at the moment and that sort of thing. So, it was Bitcoin, now it's AI, and it's a different type of funding then. It is sort of private equity, though, really, that we go to VCs and things like that. And it's hard in New Zealand, and we're not as mature as markets like the UK, again, 40 years ahead of us on shared ownership. I'm sure they're 40 years ahead of us on investment as well. So amazing job, at least, managing to get that funding through to help people.
Look, it was. I look back now and go, hey, look, we raised the money, and we set up two funds, the YouOwn Fund, and then in the Bay of Plenty Housing Fund, because that's got 3 charitable trusts behind it, and they want to help out people in their region.
Okay, cool.
And so that's pretty cool as well.
So go behind Bay of Plenty, is it?
Yes, absolutely. So we found the money, and then we managed to get a bank on board, and I'll say sort of bank singular. We've never been able to have two. We've sort of, one comes on board and then they go, and one comes, and so our current banking partner is SBS Bank, and that's working really well. So those are the challenges, but it's 7 years on. We've helped out 200 families, and 40 of those have bought out our share. So we tend to work on a model where we try and...
That's a really good outcome, 40 out of 200 as well. So it means that it is achievable to buy that back.
Yes, it is. And part of the reason is we put generally a maximum of 15% in. So the household comes in with 5, we put in 15, and SBS attaches at 80%. And the logic there is that people don't need to staircase to buy us out. I think in 15 years' time, in 5 years' time, not 15, which is the Housing Foundation model, in 5 with 15%, you can forecast out, if you pay your loan off, just some reasonable capital growth, 3% per annum.
Then you're going to get
there. 5's going to grow to 20% equity.
Yeah, I think that is really achievable. Like, I bought my first home in Raglan, and I did it with my mum as a guarantor, and then I paid her out 20 grand as a profit share over a 2-year period, removed the guarantee, and it must have uplifted by at least 10% in that 2-year period. In fact, it did, because you can only remove the guarantee when you've got 20% equity in there. Yep. So I was essentially on a low deposit of 10%, but the way that I made it work was a guarantee. And then, it only took 2 years to basically grow 10%. So, 15% across 5 years is a super reasonable situation.
Yes,
of course, the market does, sometimes have its downturns, and it's flatter now than ever. But if nothing else, over that 10-year period, but quite often over the 5-year.
And look, you're right. You need to pick the market, but we're in there forever. I mean, we're happy to own a share in their property, definitely.
Yeah. So when you can pay
when
it,
you do.
Yeah.
Otherwise, there's no pressure from us to, because we see it as a property investment.
Yeah.
And so what we're trying to do is return back to the fund the original amount we put in, plus some capital growth, and it builds the fund.
Yeah, so what does that costing look like then? So you're putting in 15% and there's some interest on that amount. What's the interest rate at the moment?
The equity charge at the moment is 5.95%.
Yeah.
So we try and pitch it about a percent below where a bank will be sitting generally.
Yeah.
And the logic of our product in our target market, which is those above the charitable products, and at the moment, to be honest, we're targeting and saying it's probably a household income of 150,000 combined.
Yeah, I thought it was 150. Yeah.
There's just some reality to buy a house in most urban centres in New Zealand. You do need that.
Yeah, and you've got the NZ Housing Foundation doing that up to 110. So you're pitching at those above that amount.
Yep.
Yeah. And can they have more than 150,000 as well?
Absolutely. So because it's a private program, there's no income caps and there's no no property cap. We're just saying buy a new house, buy an existing house, you find the house. We'll just slip in and follow the process that a bank does.
So technically you could buy a $2 million house and not have the full deposit, but you could have great, serviceability, a large amount of income.
Technically that's right, but first home buyers tend to buy in a first home buyer price bracket.
Yeah.
It sort of does tend to be sort of first standard deviation up from the average.
We've had the odd customer through that is in that 1.5 to 2 mark. Obviously they're not always needing a scheme, but sometimes they will, or their parents might be helping, or a scheme might still be the option, because I think what's really interesting is the target market of first home buyers, that age bracket, they tend to be some of the higher earners in our entire economy in New Zealand. So quite often there are people on salaries, and at a time I was on quite a large salary, around 200 and something K, and didn't have the deposit. So I think there still is that option, which is really interesting, but sometimes they just think, we're just going to have to keep saving for the deposit. But is that the right approach when the market's going to move on without you? And then you need, your income isn't growing at the same rate that the property prices are.
It'll never keep up, unless, of course, you're very early on in a trajectory of a high-income particular career. But I sort of take the view, you're in 85% of a house now, ride the capital growth curve in 5 years' time, you'll have just created the equity, and to move to 100% ownership. And that's much better than
starting out with, then trying to get to 100 and the market keeps moving.
It'll always jump in front of you. So, look, we do have high income earners, and it's an interesting thing. They come in and they tend to be high income spenders as well.
Yeah.
And so they've got the ability to actually recalibrate.
They've probably just realised that, or they've had the mindset that they can't afford those, so they're just like, whatever, I'll spend my money on whatever I feel.
But they have light bulb moments, and the people we're trying to get to are what I'd call people who have been along the journey. They've and they come to us realising that actually we are the answer to their situation, because they don't have a wealthy mum and dad that can provide that loan. And the alternative, as I might have mentioned really early on, is the low equity loan, which I think BNZ's brought it back now to 95.
Yeah, they're doing that, I think, just for existing customers at the moment and testing that out.
I'm sure they will. But when we started YouOwn, of course, those low equity loans are widely available across the market to 95. And then what it becomes is a comparison. We charge 5.95. It's like interest only on 15%, and then 80% principal and interest. But it's also at the bank's prime rate, where a low equity loan tends to be at a higher interest rate with a low equity premium. And people just
so you could be doing an 8% or something, if it's
absolutely, if you go the low equity route
with the bank.
So people will they'll make rational economic decisions. They'll go, hey, look, I'm happy to trade off 15% capital growth to these guys because I'm getting cash flow benefit of $200 a week.
And also it is at cash flow based, but potentially I don't want to make it so difficult for myself week on week.
Yep.
Right now, I want to wait for that capital to grow and then deal with that.
That's a smart way of thinking about it. Let's wait for the growth to come in, and then
then I can afford the expenses. And I think right now, if interest rates as they are, not that high as you say as what they have been in the past, but it's it's the principle that makes them high. It's the fact that it's $1 million house at 6% as opposed to a $200,000 house at 19% or something like that.
And it's where we're looking back from.
Yeah.
When interest rates hit
2%.
2.95%.
I wish we could fix it for 30 years or something in
Yeah.
New Zealand. You can do it overseas, but
Okay.
not an option
But
yet.
I was looking at it going, wow, I've never seen this in my lifetime before. And of course, people, of course, buying houses now are going, it's so expensive at 6%. And it is because of where house prices are relative to income.
Yeah.
But for those that have the income, it's a good market to think about now, because I take the view that the property market's bottomed.
Yeah.
It's probably a buyer's market at the moment.
Yeah,
and so you can
definitely
negotiate well,
pricing-wise, there's a bit more that you can...
and you can take a view that the Reserve Bank will one day reduce interest rates. And I think that's probably a pretty safe bet that's going to happen.
Yeah,
sometime,
well, I mean,
next 12 months.
a couple of months ago or a month ago, I think it was just last month actually. Yeah, a month ago, they announced that it was on hold, and there was some pretty dovish commentary around actually them saying they feel they've got inflation under control. And I think if they had have made an increase at that point in time, we might have seen another couple of increases, but the fact that it's on hold makes me think the next move could be a cut. So obviously we don't have a crystal ball, but all going well, you're right, like with property prices being a bit lower, there's the opportunity to buy in now and get the benefit of that. And yes, for a short term pay, a higher interest rate than maybe what you want to, but then you're potentially going to be able to refinance and get that lower interest rate and have purchased for a lower price than what you would have 5 years ago.
It's a rational decision. You look at it and go, yep, I will take a view that interest rates will come off in the next 12 months, so I can afford it now, and it's only going to get better.
Just back to that pricing thing as well, because obviously interest only is also great. I wish I could just keep paying interest only with the bank. But yeah, so that's what you're charging for the amount that you've put in, almost acting as a pseudo bank and going, here's 15%, you only have to pay us interest only and at 5.95. So it generally is going to be a better situation than a lot of the banks can offer right now. And then what is the capital growth that they pay? Is it based on the contribution that you make, so 15% of capital gains over the 5-year period or whatever the period is?
Yes, it is. So we essentially own 15% of the house, and when they come to buy us out, they'll get a registered valuation. And generally the bank that's lending the money will require one anyway, and we're happy to use that one. So it's an independent benchmark, and what happens is it's 15% of whatever that valuation is. So we're looking to basically, if you like, make up our lower interest rate with some capital growth.
Yeah. So say it goes up, 100 grand or whatever, and you put in, 15%, then you're going to get 15% of that 100 grand
That's
back.
right.
And then they're going to have to give you the amount as well of the 15
Correct.
that you put in.
Yep.
Yeah. So it's basically the principal that they're paying back and 50% of any capital gain, 15% of any capital gains, which is pretty much what I actually did with my mum, where it was something like 10% and 20 grand was the uplift. It was like 10% of 200 grand over that period of time or whatever when I removed the guarantee. So the structure makes sense, and I think, it's a great option for those that are in that price bracket. I guess they just have to do their, consider their options. I think what's interesting about you guys only working with one bank, because we get a lot of people thinking, I need to go speak to my bank, and that's a great place to start. I actually think working with Slice and our brokers, or our broker, is a better option, because they can actually give you an indication of all of those options that are available for you and what the product structure might be. Because we have a little calculator, a quiz on our site. I don't even know if you know this. I'll send it to you afterwards. But
thanks.
We get people to plug through like what they're earning, what their situation is, what they're hoping to achieve, existing, new build, blah, blah, blah. And then it suggests which schemes might be applicable to them. So YouOwn is one of those if you want to go through the quiz at slicetobuy.com. But I think that's another good reason to have a broker or to come to a platform like Slice as well, is because you get to see all of the options that are available to you, rather than if you just went to BNZ, or ASB, if you guys are working with SBS, they're not necessarily going to tell you about the product, the platform, the benefits of going with YouOwn. So I think it's key to think about that as well, like look at all the schemes that might be available to you.
No, we want people to come to us that are fully informed and well educated, and they know that our product is the answer for them in their situation. Yeah. Because then we've got... we then find that when we talk about our product, it's transparent, they understand the fairness of it, and they understand how they can move us on, which is what you want. There's really sort of no catches for them. And I think the unfortunate the situation we have with the banks and shared equity is that they just don't support the product. So if you did go in to see your bank and ask for a shared equity option, it's not available.
Yeah.
And you do have to go to a slice or a broker or
Directly to a scheme if you know about
program, if you know about it, like ours, to get that available to it.
And that's what we're trying to do here as well, is actually give people clarity around what their options are so that they can go through to the right product for them and see all of their options, rather than just go to one bank and then think that it's not achievable, or go to one bank and take whatever they're given that might not be the right product for them. It could be a 5% like low deposit banking option, but then you could be paying 8% instead of 5.9.
Absolutely.
So you've got to make sure that you actually are looking across all of those options.
The other thing I'd add to that comment too, I think that a broker, slice ourselves, we've put a hand up and said we're here to help you get into home ownership.
Yeah.
I think that's very different, and it can be quite a daunting process going through with your bank.
It's not
it
necessarily...
is a rules-based response.
Because they all have their different criterias, the banks, as
They
you
do.
say. They have their own criterias. They have their own, assets and liabilities and their regulatory requirements that they might have to meet, or, they might be over-leveraged in some areas and not able to offer low deposit, for example. So they have their criterias, and then they're just assessing you based on their individual criteria. So actually, that view across all of your options means that you're going to find the best criteria for you, like the best products for you. And I think that's so important for first home buyers that just don't really know where to start.
No, look, and that's not the bank's role anymore. They've sort of got out of that, so that's where financial advisors come in.
Yeah.
The bank would rather you went to a financial advisor because you'll get advice.
Exactly.
The banks are providing a product. If you want this product, here it is.
Yeah.
And we're not dissimilar. We don't provide financial advice either. We go, this is our product.
Yeah.
And people come to us, or we put them
Who are
across
the
to
right
an
fit.
advisor.
Yeah.
That's right.
That's the same. So our brokers are financial advisors. So we, rely on them to go, hey, these are the different options available to you. YouOwn and Kāinga order when it was there, which we were talking about before.
A brief moment in history.
Yeah, that flash in the pan before they opened up the criteria too wide, and then
Yes.
I think, they weren't able to sustain it. What other tips do you have for first home buyers? Obviously, the low deposit option, checking out YouOwn and seeing whether that might be a valid option for you. But generally, kind of what tips do you have? Because we know it's challenging out there.
I think engage early and get an assessment fairly early on about your borrowing capacity, because it may not be now, but it could be in the future with some changes. And I think it's having a plan, a financial plan and a roadmap, and that could well be that there is some short-term debt that when that goes, that will increase borrowing capacity. Depending where you're on your student loan, if that's got a short-term period before it's paid off, that'll increase borrowing capacity. So a lot of the stuff is understanding from the advisor what it is I need to do to be able to get to my goal. And then make a plan. And don't be despondent if that plan's a 12-month plan or longer. But if you have a plan, then your expenditure behaviour will change.
Yeah.
You don't need afterpays. It's important to understand
no
how banks
afterpay.
Exactly. Understand how banks look at you. What's
Yeah.
their lens? And if you can understand how the bank's looking at you, then you can go, so if I present myself like this.
Yeah, put your best foot forward, which again is another reason to work with the financial advisor or broker, because they're going to help you position so that you look, the best that you can.
And then there'll be, I don't want to be sort of saying, hey, in this market, get a higher paying job. I think hang on to your job, of course, at the moment. We've got to see how this trends through. But it's basically take a view that, yes, you want to buy a house, but it's not just like waking up and buying a new car to say, okay, I want to buy a house, so I'm going to have to plan for that, go get some advice, work out and make a plan.
Yeah, because generally the banks look at 3 months worth of statements
Yes.
as well. So, even with one of my friends, he came through and was like, oh, what do I need to do? And I was like, let's just start you with that broker, that financial advisor, and what they're going to tell you is that you need your 3 months, like most recent bank statements to look, like this, which means they will go line by line and say, yeah, you need to get rid of afterpay.
Yep.
If you do get rid of your student loan, you might bump, your lending up by 50 grand, or if you get rid of this credit card, a 10 grand credit card could be the difference between an extra 100k in lending. So they can actually work through your independent circumstances to position you in the best place to get ready. And that's like a 3-month period. So you're right, it's engage early, the sooner the better, because you can make those changes, and you also get educated on the amazing options that are available.
Get educated on the options and become informed about actually what drives banks and how do you get to borrow money. So,
because if you don't engage, you're not going to know, and then you're not going to know that actually I could buy with a 5% deposit or a 10% deposit. You're thinking you need 200 grand when actually could be 40, could be 20 if there's two of you. It all of a sudden becomes a lot more achievable when you do engage.
It does, and then you could have other discussions, like co-ownership. In this with the slice type product that buy with somebody else, bring somebody else into your home. It can be us, it could be somebody else. All those things are there.
All of those things may be available to you. None of them might be available to you, but you won't know until if you're not there yet, that's fine. It also means that you're on that journey. And we have a home buyers course, which is only $199 for early birds, but that actually takes people through what buying property looks like, what the different options. We talk about YouOwn in that course. You're welcome, Nigel. And
thank you.
We love your work. And so we do set out those options available, and we do help people actually just with setting up their financial statements and getting clear on budgeting and what that looks like. And no matter where you're at in that journey, you could be 2 years out, but if you start now, then you know what those options are that you might be available to you. Say you're only earning 130 grand now as a household and you need to get to 150, well then once you get there you can go with YouOwn, that sort of thing.
Absolutely.
You're preparing in advance.
And particularly in this market, it is flat. I don't know how long it'll be flat for, but I think you've got to be reasonable to say it's going to be flat for a while, because the Reserve Bank
they're not going to move quickly.
So don't sort of panic, make a plan. And look, we're happy to talk to people. Explain our product any time and just to take the journey with them.
And I think that's really important as well, because people just are a bit apprehensive. I think there's two challenges. One being mindset. They just think it's not achievable. They think they need 100 grand, 200 grand or whatever, and that's not always the case. And then the other thing is, there probably is a bit of a fear around having that conversation and how that's going to go. But I think if you do work with, a platform, or you directly engage with the provider, that can be, useful. I wouldn't necessarily just speak to one bank though. I think that's the key kind of takeaway. I think it is exploring all your different options, because if you go to one bank, they don't have any products for you and they just need 20% and they do need that 100 grand, or they don't talk to you about guarantees or other options, then that can almost be a step back in mindset, because you just think, it's not achievable, but actually it could be if you knew about some of these other schemes, And
look, I'm really happy for people to contact YouOwn or me directly, and I'll just take them, explain how it works. Take the time to do that.
It's amazing what you're doing. I think, we're fighting the good fight in the housing space and trying to make it more accessible for all. And I feel like YouOwn's, a real pillar of the options that are available across New Zealand, and they're limited, but it's so great to know that there is something there, because as you say, yes, there is the lower socioeconomic, I don't know if I should say that, but there is those that are earning, under a certain amount that do need help. But there's also those that are working really hard, earning great salaries, and just don't have that deposit. So it's amazing to have an option such as YouOwn in market.
Yes, well, that was our idea, is the product should be available to all those that want this sort of product.
And
that led to us setting it up. And look, we are small
and mighty,
but we're here. 7 years, and we've raised more funds last year, so we're looking forward to
interesting raising funds last year, because I raised some for Slice as well, but it was a challenging year. I mean, we're probably raising from different companies, and it's a different sort of investment strategy. Where I'm raising, they're investing in Slice and they're taking equity, as opposed to investing in a fund that's moving and earning returns. So it's slightly different, but it was an interesting year last year.
Really tough. And I will be honest and say we raised funds from our existing investors and people they tagged in. It would have been impossible otherwise. I mean, in a sliding market, it's very hard to sell a property investment proposition. And of course, we come back to the early comment we had, is that most of these funds anyway have got constraints on how they invest and managers that manage that money. So
think-
all that has to open up.
And that's, money's how the world goes round. It's how, you get funding so that you can help people into housing. It's how we get funding so we can help people into housing. Yeah. And banks have their own criteria too around who they can lend to so that they can make money and get people into housing. So it's just being cognizant to the fact that actually, there are investment criteria, and that impacts actually the products that are available for you. It also goes deep into the core of impacting what products we can provide as well.
It does.
So yeah, it's just keeping that in mind and doing the research to identify, which criteria is going to be most favourable for you. In our closing question, we like to ask Nigel, if your home had a doorbell and that doorbell played a theme song, what would it play?
Oh my goodness. Well, I'm going to say Stairway to Heaven because I saw it coming up here and it's one of my favourites from my youth, Led Zeppelin.
It's a good song. And then I was just thinking, that made me think about staircasing and how you can purchase out a property. I was like, there's some relevance there. Staircasing, Stairway to Heaven, Stairway to Home Ownership.
Yeah, beautiful song.
Yeah, lovely song and lovely mission. Thanks for joining us, Nigel.
Thanks, Amy. It's been great to catch up again.
Yeah.
Let's do it again in 12 months' time and see how we've gone.
Let's see where the market is then.
Okay, thank you.
Thank you for joining our community. Buying property isn't easy, but listening in will get you one step closer on your journey. Please leave an Apple or Spotify review and provide feedback so we can improve your experience. Join our Facebook group, A Safe Space to Learn Together, or follow us on Instagram at Slice2Buy. If you have any questions or topics you would like us to touch on, you can email us at hello@slice2buy.com. A quick reminder, Slice the podcast does not provide personalised investment advice. We are not acting as financial advisors or taking into account your circumstances. To get personalised advice, join us at slice2buy.com and engage with our partners who can act as your financial advisor or lawyer and support you with your specific needs.